Did you know the average cost of flipping a house has increased by over 30% in the past few years? Whether it's higher renovation cost or rising interest rates, one thing is clear. How you finance your flip can make or break your profits. In this video, we're diving into the top 3 financing options for fix and flip investors and helping you figure out which is the right one for you. Stay tuned. Hey guys, I'm Brandy Leiden, host and founder of Mom You're Not Alone. I'm also a local realtor and investor here in the Knoxville, Tennessee area. So the first thing we're going to talk about is hard money loans. So let's start with the first option, hard money loans. These are going to be short-term, high-interest loans, specifically designed for real estate investors. They're fast, they're often approved within days instead of weeks, and they focus more on the property's value than your credit score. So why would you use a hard money loan? Hard money loans are perfect if you find a deal that needs to close quickly. For example, let's say you find an off-market deal and it's 60% of its after repair value, it's ARV, but the seller wants to close in 2 weeks. A hard money lender can step in and fund the deal without the red tape of a traditional bank. What's the catch? Well, you'll pay for that speed. So interest rates can range from 8% to 15, 20%, and most of these lenders charge points up front. It might be 1% or 3% of the loan amount. Now, it's a great option if you're confident in your numbers and you plan to flip the property within 6 months or something like that. Now, a pro tip would be always have an exit strategy. So know how you're going to repay the loan, whether it's selling the property or refinancing into a conventional mortgage. So if you decide that, let's say you've got this property that you're thinking in your head you're going to fix, you're going to flip it. This is all going to happen within, let's say, 90 days, 6 months at the longest, and then you decide this could be a good rental. And so you decide you want to hold this property. So that is what we're talking about. You're going to want to refinance into a conventional mortgage at that point. Okay, so number 2, private lenders. Next up is we're going to talk about private lending. So think of this as borrowing money from an individual rather than a financial institution. Private lenders can be family, friends, or even other investors. So why would you use private money? The beauty of private lenders is just the flexibility. So they're more likely to work within your timeline and your terms. For instance, if you need funds for a flip that requires major renovations, a private lender might be more willing to take the risk than a bank or even a hard money lender. So here's an example. A private lender might offer you a loan at 6 to 8%, let's say, interest, with no points up front. In return, you're going to give them a lien on the property and agree to repay the loan within a set time frame. So it's often a win because they can earn better returns in the stock market and you get the capital that you need. Now, what's the challenge with the private lender? Private lending usually requires strong relationships and trust. So if you're just starting, networking at local real estate meetups or investor groups can help you find potential lenders. You know, we mentioned in the beginning, this could be family, it could be friends, it could be, another investor. And a lot of times people will partner up on these things. So you might partner up on a flip and the money backing this might be half, and you, with your experience and your time to put in to project manage the flip, might be half of the profit. So you can start building these relationships maybe by going in and partnering on a flip up front if you don't have the relationships built. Okay, the third thing we're going to talk about is HELOC. So what is a HELOC? It's a home equity line of credit. If you own a home or multiple properties with significant equity, you can tap into that equity and fund your own flip. So why would you use a HELOC? HELOCs are one of the most cost-effective options out there. Interest rates are typically lower than hard money or even private loans. They're often around 5 to 7%. Now this is going to vary when we're talking about and interest rates. But I did talk to a friend that did a HELOC and it was mid 6%, so 6.5%, which is a really great rate, in this day and age, 2025, for HELOC. Now HELOCs are going to be revolving, meaning you can reuse them for future flips. So let's say, here's a real life example. You've got $100,000 in equity on your primary resident. You take a HELOC out, you use $50,000 for your flip and only pay interest on that $50,000 until you sell the property. Once you sell, you can repay your HELOC and use it for the next deal. Now the downside, your home is on the line. So if your flip doesn't go as planned and you can't repay the HELOC, you risk losing your property. Now, I would say do not HELOC your home if you can't afford what that payment is going to be. This is best suited for experienced investors with a solid plan or somebody that's got some 3 to 6 months of extra savings, extra let's say all your bills, 3 to 6 months of all your bills, put back into a emergency fund. Let's talk about some takeaways here. Each of these options, the hard money loans, the private lenders, and the HELOC, they have its place in the world of fix and flip investing, right? We want to use hard money loans when speed is critical and you're confident for a quick turnaround. You want to lean on private lenders when you need flexibility and you want to build long-term relationships for these. And if you have equity in your home, consider the HELOC because it's low cost and you can continue to reuse this loan for flips for your down payment. All right, guys, if this video gave you any value, don't forget to like and subscribe and share it with anyone who might benefit. Thanks so much for watching.